Good morning or afternoon, everybody, depending where you're calling from. Welcome to our webinar or Aminar about understanding the Main Street Lending Program funding forward. Please post your questions in the Q&A only. A recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com. Late in the day, we will also email a copy to participants. Briefly about myself, I am the founder and CEO of MultiFunding. I am Inc. columnist writing regularly on business lending issues. I've advised the prior administrations as well as the Federal Reserve about the business credit markets. I have a book out on Amazon called The Growth Dilemma. And for my entrepreneur organization friends out there, I'm a member of EO Philadelphia. My attorneys asked me to share a few disclaimers. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement this program. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. This is the time for us to be thinking about what is next for our business. Will we pivot 5%, 50%, or 90%? What will our teams look like going forward? And what cash will we need to ensure our operations? How much cash will be required to get your business back up on stable footing? What is the best case and the worst case scenario? And where will the cash come from? And what does the future look like? And what opportunities do you want to consider? These are the opportunities and veins that I think you should think through the Main Street Lending Program. It has $600 billion allocated towards it as part of the CARES Act. It is in effect until December 30th, 2020, and is comprised of 3 facilities: the new, the priority, and the expanded. It is important for everyone to understand that the Main Street Lending Program is not an entitlement program like PPP. If your business has been badly hit by COVID-19, your best chance for a Main Street loan will be through your existing bank. If you plan to use a Main Street loan to expand and grow, more banks will be open to you. Program is live, but getting off to a very slow start. Most participating banks are getting up and running, looking at deals, and trying to figure out how they're going to apply the rules, what the rules are, how they're going to underwrite them, and what their risk tolerance is. The list of lenders on the Federal Reserve site that are offering to new customers is up, but is limited and not entirely accurate. And the program has been extended until December 31st. You have to understand here the motivation of the lenders. If you have existing debt with a lender, they might be more inclined to give you a loan, especially if your business has been hit, because they are interested in protecting their current liability. And for a new lender, are largely going to be looking for strong credits and new banking relationships. There are, according to the Federal Reserve, about 500 banks, savings associations, or credit unions registered for the program. To be eligible, your business must be established prior to March 13th, 2020. If you have more than 15,000 employees or 2019 annual revenue of $5 billion, you're too big. And your business has to be created or organized in the United States or under the laws of the United States with significant operations in the US. To meet the US eligibility test, at least 50% of your assets must be in the US, 50% of your annual net operating income generated in the US, and 50% of your annual net operating revenues are generated in the US. Subsidiaries of foreign companies can apply as long as they attest that they will not send the money abroad to their parent. Eligible entities include partnerships, LLCs, corporations, associations, trusts, cooperatives, joint ventures with no more than 49% participation by foreign business entities, or tribal business concerns. Sole proprietors are not eligible to apply for the program. Nonprofits can apply, but under a different program. Developers and landlords are not eligible, as well as people in the gambling business, money lending business, sex business, etc. If you are part of an affiliated group of companies, so there are multiple companies under one umbrella, the affiliated groups can participate in only one of the 3 Main Street lending facilities, and the affiliated group's loan cannot exceed the maximum loan amount for that facility. Let's start by talking about the new and priority facilities. They share some attributes. They are secured or unsecured term loans that have a 5-year maturity. Principal payment is deferred for 2 years and interest payments are deferred for 1 year. You pay 15% at the end of year 3, 15% at the end of year 4, and 70% at the end of year 5. They are priced at an adjustable rate of LIBOR plus 3%, currently approximately 3.18 to 3.31%. Prepayment is permitted without penalty, and the fees to get in are 2%. The new facility loans start at $250,000 and go as high as $35 million. To calculate how much you might be eligible for, you take your 2019 EBITDA, let's call it $500,000 in row 3. The maximum of that is 4 times that, so $2 million. And then if you subtract $1.5 million from that, you get a potential new money for loan of $500,000. If that same company in row 1 had $500,000 worth of existing debt, their potential new money loan would be $1.5 million. What's important about these loans is that if you have other lenders, those lenders will have to agree that in a case of bankruptcy, they will share rights with your Main Street lender. However, in the normal course of business, these lenders did not have to share rights with the Main Street lender. These loans can be secured or unsecured, depending on if you have other debt and what you're able to work out with your lender. The priority facilities start at $250,000 and they go to $50 million. And these work at 6x EBITDA instead of 4x EBITDA. So if you take row 3, a company with $500,000 of 2019 EBITDA, the maximum they could get would be $3 million. If that company had $1.5 million worth of existing debt, their potential priority loan would be $1.5 million. If that same company in row 1 had $500,000 worth of existing debt, their potential priority loan would be $2.5 million. What's unique about these loans is that you can refinance other debt into them as long as it's not debt with your existing lender. And the lender's rights are senior or on par with all of your other lenders except for your mortgage lender in all times in bankruptcy and regular times of business. And these loans can be secured or unsecured depending upon if you have other debt and what you work out with your lender. The expanded facilities are bigger. They start at $10 million and they go as high as $300 million. So to take row 2, a company with $10 million of 2019 EBITDA, the maximum they could get is $60 million. If that company had $50 million worth of existing debt, their potential expanded money would be $10 million. These loans share similar attributes, except the rights tag along with the existing lender and the fees to get in are smaller, between 0.75 and 1.5%. For all these loans, you commit that you will not use the proceeds to repay or pay down other debt while you have the loan or shut down the line of credit unless it is debt that you're refinancing as part of the transaction. And you certify that you have reasonable basis to believe that your business will not go bankrupt in the next 90 days. While you have the loan, you can repay a line of credit, including credit cards, in the normal course of business. You can take on additional debt obligations as long as they do not interfere with the rights of your Main Street lender, and you can refinance maturing debt. You do agree to certain certificates and covenants, including restrictions on stock repurchase and capital distributions. There are exceptions to these for S corporations or other tax pass-through entities. While you have the loan and for up to 12 months after you have the loan, you agree not to pay dividends or make other capital distributions with respect to the common stock of your business. For those earning between $425,000 and $3 million in 2019, you agreed not to earn more than that while you have the loan in 1 year thereafter. For those who earn more than $3 million, say you earn $6 million, you take the delta between 3 and 6, 1.5, you add that to the 3, and that caps at $4.5 million. While you have the loan, you agree to make reasonable efforts to retain your employees, although unlike the PPP program, this is not the main priority. Your lender, if it is a lender that you've worked with previously, will calculate your EBITDA in the same way they have historically done it. If it is a lender that you're working with for the first time, they will have to calculate your EBITDA how they've done it for similar companies like yours before. Your debt will be calculated on the date of your application, including all drawn and undrawn debt from private and bank lenders. And if you have an asset-based line secured by accounts receivable and inventory, the amount will be the amount you have borrowed, not the amount you could borrow. So how do you determine which one is best for you? Well, if you had a $4 million worth of EBITDA and $10 million worth of existing debt, that could get a new of 6, a priority of 14, or an expanded of 14. It would depend on what your needs are and what you could work out with your bank. Financing strategy is like offensive and defense. I'll share with you 3 case studies. One is a company with a $3 million line of credit and $1 million drawn. The line of credit has a personal guarantee. This borrower is planning on getting an MSLP for liquidity. They would rather not draw down their entire line. Example number 2 is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. And example number 3 is a company that has already been approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. So how much cash will be required to get your business back up on a stable footing? What is the best case and worst case scenario? And where will the cash come from? And as you look at your future, what do you consider? Those are the end of my prepared remarks, and we'd be happy to take your questions now in the Q&A. Thank you so much. Please feel free to punch in any questions that you might have in the Q&A, and we'll be happy to respond. Or it's a small group today. If you want to raise your hand, you can do that also. Happy to take any questions, folks. Questions are going once. Questions are going twice. Give you another 30 seconds here. Okay, we really thank you all for your time. Oh, we have a question.
Do you think there's a chance we get a new PPP program?
Ali, I'm done predicting anything that comes out of Washington. So I would have hoped that it would have been resolved weeks ago, but so far they don't seem to be anywhere close to it. Any other questions? Okay, we thank you all for your time and we wish you all a good day. Take care now. Thank you so much. Bye-bye.